Have you ever heard of the story of Jack and Jill? You know, the pair who went up the hill to fetch a pail of water. Well, they might have taught us a thing or two about assets and liabilities without even knowing it. You see, Jack and Jill had different outcomes based on their choices. Jack decided to invest in a well, making it his asset, while Jill opted for a leaky bucket, which turned into her liability. In this video, we're not climbing hills, but we are diving deep into the financial world of assets and liabilities. Many people confuse the two and end up making poor choices that hurt their finances. So stick around if you want to know more. Welcome to the Finance Virtuoso channel, where we talk about all things finance. If you're seeking a daily dose of valuable information on money, business, investments, and savings, be sure to click the notification bell and hit the subscribe button now. So, let's get started with the most important question. What are assets and liabilities? To put it simply, the difference between assets and liabilities is fundamental. Assets are things that put money in your pocket, while liabilities are things that take money out of your pocket. It's as clear as day that your goal should be to acquire as many assets as possible and minimize your liabilities. In this video, we're going to take a closer look at the distinction between assets and liabilities. We'll also provide you with strategies on how to accumulate more assets and reduce your liabilities. Now, let's start with a clear definition. In financial accounting, an asset is anything that can be utilized to produce value, and by value, we mean money. This is where some people often miss the mark. For instance, is a house an asset? Well, it depends on your intent. If you plan to sell it for a profit, it's an asset. But if it's solely for personal use, it's a liability, especially considering the mortgage and maintenance cost involved. Investments, such as stocks and bonds, also fall under the category of assets because they have the potential to generate measurable returns. But why should you care about assets? Because assets are your friends, while liabilities are your enemies. Assets make you richer, while liabilities make you poorer. Assets can help you build wealth, achieve financial freedom, and create passive income streams, while liabilities can drain your cash flow, increase your debt, and limit your choices. Is a car an asset? Now, what about cars? While some argue that cars can be assets because they can be resold, a good asset should generate a profit. Most cars rapidly depreciate, making them poor choices as assets. There are exceptions, like historic or collectible cars that can appreciate in value. But we're talking about everyday cars for personal use. So how can you reduce your car expenses or turn your car into an asset? You can save money by buying a used car instead of a new one, or by using public transportation or carpooling whenever possible. You can also turn your car into an asset by renting it out on platforms like Turo or GetAround. These are ways to make your car work for you instead of against you. Tangible versus intangible assets. Next, let's distinguish between tangible and intangible assets. Tangible assets are physical, such as land, property, equipment, cash, and inventory. On the other hand, intangible assets like brands, patents, and copyrights are not physical and still hold significant value. However, owning intangible assets also comes with some challenges or risks. Intangible assets can be tricky to measure, protect, or turn into money. They may also lose value over time due to changes in technology, consumer preferences, or competition. That's why it's important to keep innovating and updating your intangible assets to maintain their relevance and edge. Financial versus real assets. Financial and real assets are often mixed up. Real assets have intrinsic value, while financial assets derive their value from market trading. It's crucial to understand this difference as it affects your investment decisions. For example, a gold bar is a real asset because it has a physical form and a value based on its weight and purity. A gold ETF is a financial asset because it represents a claim to a certain amount of gold held by a fund. The value of the gold ETF depends on the market price of gold and the demand and supply of the ETF. There are advantages and disadvantages of investing in real assets versus financial assets. Real assets tend to be more stable and less volatile than financial assets, but they may also require more capital, maintenance, or management. Financial assets tend to be more liquid and diversified than real assets, but they may also be more susceptible to market fluctuations or inflation. It's wise to have a balanced portfolio of both types of assets to optimize your returns and minimize your risks. Stocks, the mother of all assets. Now let's talk about the mother of all assets, stocks. Stocks are fractional ownership in a company. When you purchase a stock, you become a shareholder. If you own enough shares, you may even have voting rights in the company's decisions. There are two primary ways to gain profits from stocks. First, through capital gains by buying low and selling high. Second, through dividends, which are your share of the company's profits. Stock prices are influenced by many factors such as supply and demand, earnings reports, news events, industry trends, investor sentiment, and more. Stock performance depends on the company's profitability, growth potential, competitive advantage, and dividend policy. That's why it's important to do your research and analysis before investing in any stock. To acquire stocks, open an investment account with an online stockbroker or your bank. They facilitate stock trading but do charge fees for each transaction. You should look for a stockbroker or bank that offer lower fees, high security, a user-friendly interface, reliable customer service, and a wide range of investment options. You should also compare the features and benefits of different platforms to find the best one for your needs and goals. Real estate as an asset. Real estate can also be a valuable asset if handled correctly. Buying underpriced properties, fixing them up, and either reselling or renting them can turn real estate into a profitable asset. There are different types of real estate investments, such as residential, like houses or apartments, commercial, offices or retail spaces, industrial, warehouses or factories, or land, farms or vacant lots. Each type of real estate investment has its own pros and cons, such as location, demand, supply, cash flow, appreciation, taxes, and regulations. You should consider these factors before investing in any property. If you're not ready for property investment, consider real estate investment trusts, or REITs, as a way to invest in real estate without the hassle of property management. REITs are companies that possess and operate income-producing properties. They trade on stock exchanges like regular stocks, and they pay out most of their earnings as dividends to shareholders. REITs offer several benefits, such as liquidity, diversification, low entry costs, and high income potential. However, they also have some drawbacks, such as volatility, leverage risk, tax implications, and fees. You should weigh the pros and cons of REITs before investing in them. Is knowledge an asset? Lastly, let's touch on an intangible asset, knowledge. If you acquire a valuable skill, you can become an asset yourself. Entrepreneurs will pay for expertise that helps grow their businesses. Learning is key, and the better your knowledge becomes, the more you can earn from it. You can acquire knowledge or skills from various sources, such as books, podcasts, online courses, mentors, or personal experience. The more you learn, the more you grow. The more you grow, the more you earn. The more money you earn, the more assets you can acquire. And the cycle goes on. Well, that wraps up today's video on understanding assets versus liabilities. We hope you found it informative and valuable. If you did, don't forget to give it a thumbs up and share it with your financially virtuous friends. Thanks for tuning in, and we'll see you in the next video.